What is up, everybody? Logan here again with another video, and today I'm joined with Vance, and I'm actually getting over like this little cold I have right now. So Vance and I are actually going to go over the expected move study today. He's going to be doing most of the talking. Before we get into this one, if you guys could leave a like, a comment, and subscribe, I'd really appreciate that. Vance, I really appreciate you taking the time to come on for another video, and I'm really excited to kind of take a dive because I think one thing a lot of people don't realize in this current market, especially if you're tracking the expected move, is we used to not have expirations every single day like we do now, which is creating a lot more volatility. You see a lot more closes around specific levels on days where the market would never even do that, right? And the SPX options flow is like way higher than it used to be as well. Now that we have the 0 DTEs and the 1 and the 2 versus just maybe a weekly one or some on Monday, Wednesday, Friday. So Vance is going to take over from here for most of the video, but I really do appreciate you coming back on, and I'm excited to see what you got for us.
Hey, not a problem, Logan. So yeah, we're going to talk about the expected move today. Obviously, this is going to be a little bit math intensive, number intensive. So I apologize ahead of time. It's going to be a little bit nerdy, but it's some really good information in here. So just to kind of give everybody a background of what we looked at, I pulled the expected move and all the data basically from a timeline of January 3rd, 2018 until November 9th, 2023. And basically from there, I eliminated any day that did not have SPX options expiring that day. So, if it's a Tuesday and there wasn't an option expiring that day, there is no expected move for the day. So we just ignored that data and just didn't go with it. When we pulled the data, we pulled the expected move as of close of the previous day. So if tomorrow, let's say, was a Friday, I went back and looked at the Thursday right at 4:00 p.m. and I pulled the expected move for Friday's close at that moment. I find that gives the most accurate information because you'll get some overnight moves with gapping up or gapping down, and that won't give you a true expected move reading that way. In totality, we pulled 1,072 days of data. And then I went one step further and I cross-referenced big time events. So what I looked at was CPI, FOMC meeting days, not minutes days, just meetings, option expiration, PPI, and quad witching days. And I wanted to compare the expected move rates on those days versus the standardized expected move rates. So we can get a baseline of, are these days to avoid, or are they days to trade? And there's some other metrics I measured in there as well. So when we look at our baseline results for just the expected move, one top, right, which is the top or the bottom. There were 1,072 days. There were 648 days where we closed inside the expected move, which is 60% of the time. There were 424 days where we closed outside the expected move, which is 39.55% of the time. Now, that's to be almost expected. It's actually a little bit lower than what the true math should say. Generally speaking, they say that the expected move is one standard deviation. And in math speak, one standard deviation should be 68% of the time. So this actually says the expected move actually underperforms that and comes in a little bit less often than it mathematically should. And I personally believe a lot of that is due to overall options volatility. One of the other things that you'll find is since we've gone to everyday expiration, this expected move value has increased a little bit. It's closer to like 63%. So basically for the past 3 months, it's a little bit more accurate. And what you'll find is if you go back and look at the historical data, you'll see a day where we moved like 85 points on an option expiration day. And then the next day, let's say a Tuesday or a Thursday, where there wasn't options expiring, the day would move like 8 points. So if there was an option expiring that day, it would have definitively closed inside the expected move, but there wasn't. So those days, those data gets thrown out. So that was one of the things that we found. So what's interesting here is we're going to look at, whether it closed above it or below, to the top or the bottom side. So as to be somewhat expected, there were 235 closes to the top side of the EM and 189 closes to the bottom side. The reason why I say that's expected is because this is the general tilt of the market in general, is that 53% of days are green and about 47% of days are red. So it would make sense that if we're going to break the EM, more often than not, we're going to break it to the top as opposed to the bottom. So that data basically lines up to where we would expect over time.
Mm-hmm.
So the next thing I looked at was if we took the expected move and we multiplied that by 1.5. So if the EM was 20, we're going to measure it as if it were a 30. Obviously, if you're taking a trade at that level, you would get less credit. But how often does it perform? How often does that work out? And again, 1,072 days. What we found were that 840 of those days we closed inside of that range, that EM range. That's 78.36% of days. 232 times we closed outside of the range, which is 21.64%. So again, if you're taking a trade at 1.5 the EM, you're going to win a lot. And one of the things you can do when you start looking at this in the 2x EM range is you can say, well, these are the marks on the map, and maybe as it approaches it, we'll take a trade when we get a higher credit. Because organically, you're probably only going to get like, I would say probably 40 to 50 cents on a 5 wide at this level. So again, we're going to look at the top versus the bottom for bricks. So this falls a little bit more in line. There were 123 closes to the top of the EM and 109 closes to the bottom side of the EM. So again, that gist is still upwards. If it's going to break, it's probably going to break to the top, less often to the bottom. The next one we looked at was the EM times 2. So again, if the EM was, let's say, 20, then we would be going as if we were treating it as if the EM was 40. This is where the numbers start to really skew. You're going to see that 978 days closed inside of this 2x EM range. It's 91% of days. It happens and closes out inside that range a whole lot. Only 94 times did it close outside the EM, which is 8.77% of the days. This is where things get very interesting, though, with that top-bottom skew. You'll see that when we reach this level, there's more closes to the bottom side of the EM than the top. The numbers have switched. Only 38 times did it break and close to the top side of the EM, as opposed to 56 times it closed to the bottom. Again, this makes sense because in general, there's larger days to the bottom side than there are to the top. So a 1.5% move in either direction is rare. However, it's less rare to the bottom than it is to the top. You just get more of them because people generally, when we have a sell-off, people tend to stack into that. So we'll get larger moves to the downside. So if you're taking a far off trade, you're almost better off taking it on the call side than the put side. You're less likely to get caught in that direction. So now let's take a look at some very specific events. CPI. So there's a lot of people who will say, hey, we're not going to trade these days, right? These days are super volatile. We're not going to trade them. Well, here we are. You're a good example. You're one of them. The CPI. There were a total of, that number's typed up wrong, but there were a total of 43 days where CPI occurred on an expiration day. 30 of them closed inside the EM, which is 66.67. And that should be 13, but I typed 14 or 15 because I'm silly. Closed outside the EM, which is 33%. So that's an interesting thing. What that's telling us is that when you think back at that baseline, the baseline percentage was 60%. So actually, CPI days are actually more likely to expire worthless or expire inside the EM than just your baseline EM day, which is an interesting factoid. This is what I did. I transposed the FOMC in the CPI. That's what I did. So there were 45 days where FOMC occurred on the expiration day. Again, same thing. The EM is pumped up for FOMC. Almost 70% of the days closed inside the EM. And actually, these numbers are going to be backwards. This should be 66%. The other one was 70%. So CPI is actually 70%. and FOMC is 66. But again, it's the same mentality. The baseline EM was only 60%. So CPI and FOMC, they're actually less dangerous than just your basic normal EM day trade, which is kind of interesting. So option expiration, OPEX. So when you talk about OPEX, there's two types of OPEX days. There's OPEX, and then there's quad witching. So all quad witching days are option expiration, but not all option expiration days are quad witching. So I excluded quad witching from this because that's a separate metric. This is a day I would say don't trade. Of the 80 total days, 56% of them closed inside the EM. That's lower than the baseline. The baseline is 60%. So if you're going to trade OPEX, you actually have a lower than average chance just going into the trade, trading the EM band, whereas 35 days closed outside of it. So you still more days than not won, but it's less than just the normal day, which was interesting. PPI was 43 total days, 26 closed inside the EM, and 17 closed outside the EM. So what's interesting about PPI is a lot of PPI days actually fell on Tuesdays or Thursdays back in like 2018 and 2019. So there's actually less total days because we couldn't trade those because they fell on non-option expiration days. In the past 18 months, since every day is OPEX, or since every day has an expiration, you could trade every day. So these numbers fell pretty much in the baseline. PPI really didn't have an advantage or disadvantage over the normal baseline numbers.
Nice.
Quad witching. Quad witching is another one of those days that people are always like, it's quad witching. Don't trade it in quad witching. Well, 65% of the days closed inside the EM as opposed to 8 closing outside of it. That's a 65%. So again, quad witching is one of those days that has this really scary negative connotation. But realistically, the numbers just don't show that it's a day that you should necessarily avoid because it's going to close inside that range more often than not. And again, keep in mind that with all these big events, every single one of them, generally speaking, the EM is going to be larger on those days than just a normal day. It's kind of built in. So if you're looking at one of those 1.5 or 2x days, these numbers, especially in the ones that are higher, right, they're going to be even better. So if you took like a 2x trade on a quad witching day, you probably have a 95% chance of it closing on a 2x EM iron condor built in because the EM is already going to be buffed. And that's pretty much the study I've got.
Awesome. So a couple things. What stuck out to me was OPEX or OPEX, right? Options expiration. I found that, I really don't trade options expiration very often, but it's never really been on my radar. And I think one reason for that is because it doesn't have like you said, the connotation that that quad witching does, right? So for me, I wonder if a day like that would be one of those days where you could actually take more directional plays, right? Because now, granted, you still have to get the direction right, but if we're closing outside of the EM band more often than the standard, right? Like our standard, was it 61% right now, right?
Yeah, about 61%.
Yeah, around 61. You might find your edge there, right? Like if we continue to see movement like that, right? You could actually get a decent, because the way I like to trade, right, is I'm always doing 2x the EM, and my edge comes from our price levels and our price action. And that's why I have a high hit rate, because if I'm doing 2x the EM, I should be hitting at 91% roughly. And that's why our hit rate's so much higher, is because of that edge, right? Like understanding where the market is. So if you're somebody who is really good at trading PPI or OPEX or FOMC, because there are a lot of guys who do really well on those because it's so psychological. OPEX seems like one of those days you could be a little bit more directional and do well. Because if we're closing outside the EM band, or if whether we started the day there or you did a swing trade and you get the direction right, and then it goes outside the EM band, you're collecting that entire move on just a one-day swing trade. So that got me thinking quite a bit. That's where my head was when we were going over some of the examples. Do you think that, so taking a look at everything, what surprised you the most, Vance? Like what in your mind, actually do you find like, hey, I want to take more 1.5 times the EM, or hey, I actually think Opex day is going to be, I'll never ever trade it again. Like, is there something that after you did this study completely changed how you view trading? Because I know for me, sitting here and listen, and I know we've been talking about it off screen for a few weeks as well. So I've had a little bit more time to kind of dabble with it, but it's making me want to get more directional, when we have those, right? Like if the market's down at 1.5 times, like instead of going maybe further out of the money, I can get a directional trade going in the other, like almost like a reversal trade. Like, is there anything like that has kind of popped up through your time?
The big thing was the OPEX information. Like this one right here, that really surprised me because I've always kind of felt that OPEX was kind of overstated, and even compared to quad witching, I felt that quad witching was actually way overstated and wasn't nearly as volatile as it seemed. So those numbers didn't surprise me as much as this. Like I didn't expect to actually see this not work out as high as it should have. What I find is, and today was kind of the proof of the pudding, which is where today the market opened up like 15 points. And a lot of people immediately, I know, jumped into a PCS just thinking the continuation play. But when you go back and you look at the fact that, when you look at just this number right here, that 60% of the time we're going to close inside of that EM range. What that tells me is that you have to be very careful when you go to play those AM or those in the morning type overnight market moves, because if you place a PCS on the top side of this range, more times than not, it's going to back up and come back inside of the range. So if you're at the top of that EM range, you're actually kind of putting yourself in danger, because exactly what happened today was the market opened up and then it came all the way back down. And then if you had put a PCS on, you might have gotten run over today, thinking, market's just going to keep going up, market's going to keep going up, and it didn't. So I'm a real big believer in the fact that when the market starts opening up, there's a higher degree of likelihood that it's going to hit a top and come back down. And yeah, you have to kind of find that top. But again, if you go back and say, okay, the market moved up, but I know that, only 8% of the time is it going to close above the 2x the EM. So if you look at the market and you say, okay, last night the market closed at this number, 44, 45.50, EM is 20, so 2x that is 90 or is 40. So I'm kind of keeping an eye on like the 45.95 for a short all day long. The market runs up and goes up to that. That's a little bit more than 2x the EM from the overnight. And I know that organically now I have a built-in mathematically over time, there's only a 9% chance that strike's going to close in the money. I'd rather wait, take that strike on a 5 wide for like $1 than with a CCS, than put on a PCS and hope for the continuation, because mathematically the market's going to come back more often than it continues.
100%.
Math kind of says.
Well, and that's another really cool thing, right? Is like if it's 8.7%, we can round up to 9, just so that there's nobody in the comments of this video that backfire at me for like our statistical edge. But if you're getting $1 on a 5 wide, that's 20%.
Right.
And let's say it's 9% of the time, right? You're at the 2x spot and you're getting 20%, there's your 11% edge, right? Like that, there's your built-in 11%. So, right, like statistically, that is a good trade. And that's what this game is, right? It's just literally taking statistical edges and running with them, right? And having a long-term positive expectancy based on how you trade. That's all this is. That's it. That's all trading is. And that's why this is so cool and interesting, because like I love trading outside 2x the EM. And I know I like my hit rate's higher than, of course, like closing within and outside the EM as well. But there's also a lot of times throughout the last few years, of course, where I wait till certain points of the day to take a trade, or a lot of my zero DTEs used to be, hey, this is 2x the EM, and we're getting like a 13% return on it. We have a built-in 4% edge here. Let's run this, and then of course, there's so many other indicators and internals I go through, but that's what I find really interesting about this. And this is the most beneficial page to me, because I like that 1.5 to 2x the EM for trading. Because I swear so many times you'll see the market on volatile days will hit the top end of the band and then also hit the bottom end of the band. So if it was like a 30-point EM and you see a 60-point range, most likely went from the top to the bottom or bottom to the top. And those are the days that crush a lot of people, right? That are intraday trading.
And that's the thing is, with a lot of these statistics are all based on two things. They're based on essentially, both sides of the band. And it's also based on a close-to-close basis, not touch, because you can touch approximately twice as much. So if it's going to close outside the EM 8% of the time, it's probably going to go past it about 17 to 18% of the time. That's just the way the math in the market works. So there's a lot of people who will take a trade outside, the 2x EM range, but they'll have a stop loss or something that's way before it, and you're ruining your statistical edge because you're not playing the true math. You're not playing the true odds. Mm-hmm. And that's part of it as well, is that, if you're going to take some of these types of trades, you sometimes have to kind of like suck it up, and you got to go in for the ride, because, if you're getting 30 cents on a trade, right, you're probably not getting a good mathematical edge in terms of the money you're getting. But also then you have to be willing to play the odds on that. That's why sometimes, if you feel confident in the direction, right, you wait till you get a little bit better credit, a little bit better fill, and then you take the trade. So like you said, we have a statistical edge in terms of the credit we're getting paid for versus the actual statistical odds that historically have occurred.
Awesome. Yeah, I really appreciate you taking all the time to pull all the data together too.
Not a problem. It's taking a little bit longer than I wanted it to, but that's life and work. So
yes, it is, trying to balance everything. But I really do appreciate you coming on for this one. I'm pretty sure we've covered everything that I wanted to in this one. And yeah, pulling all that data together, especially because like I mentioned earlier at the beginning of the video, we haven't had expirations every single day until May of 22, right? May of 2022. So yeah, this is like brand new to everybody, the last year and a half specifically, of having expirations every day, the SPX options flow taking over all of options trading, right? Like that becoming such a popular thing. And then using the expected move gives you some sort of like, I guess, linear statistic to base yourself off of because of how consistent you see, right? Like the data that we're plotting. So that's one thing that's really interesting to me, but I really do appreciate you taking your time, and, it's super beneficial, of course, to what we're doing here, on the channel, but also with Amplified, and then all the stuff you got going on as well. So, yeah, I really do appreciate it. But that's going to be everything for Vance and I in this video. If you guys have any questions, feel free to leave them below, and we'll get to those, of course. And then we can always make a recap video answering some of those questions as well. But if you guys have yet to leave a like, a comment, or subscribe, do that now. But that's going to be everything for us, and we will see you guys in the next video.
Thank you, everyone.